Former FDIC Chair Sheila Bair joins us now with more on the bank. She's also the CNBC Global Financial Wellness Advisory Board. Sheila, it's always great to see you.
Nice to see you. Thanks for having me.
I understand that you think the big banks are largely in good shape, nothing to worry about here. But even with the economy pretty strong still, you are worried about the regional banks. What do you think is that shoe that's going to drop there?
Well, I think I'm worried about a handful of them. I think some of them are still overly reliant on uninsured deposits, have a lot of concentrated commercial real estate exposure. And then I think the larger picture really is the potential instability of their uninsured deposits, even for the healthy ones, if we have another bank failure. So I do, as I said before, I think Congress should reinstate the FDIC's transaction account guarantee authority so that they can stabilize those deposits. Congress isn't doing much of anything these days, so wait in line. But I do think that this is still a problem for the regional banks, and fingers crossed if there's another failure, we're just quite not sure what's going to happen.
The 10-year yield at 4.6%, and some forecasting it to go to 4.75%, 4.8%. Does that concern about regionals and the exposure to commercial real estate, does that heighten?
Well, yeah, I mean, the higher the rates. So part of the problem with commercial real estate is that a lot of it's refinancing this year and next. So the higher the rates go for those refinancings, the more distress there will be with borrowers to be able to continue with their payments. But with CRE, the commercial real estate, we had this problem during the great financial crisis. There are things you can do. There are workout strategies. Some people pejoratively call it extended pretend. You don't want to do that. If the borrowers cook, the borrowers cook. But a lot of these borrowers can get through with some active workout strategies. So I still think it's a slow burn over time. And again, the big issue is whether there's another shock to uninsured deposits because of a bank failure. And I think that is really the biggest challenge confronting regional banks right now.
Hey, Sheila, it's Tim. Thanks for joining us. I share your view that the big money center banks are in a very different balance sheet place than some of the regionals. I guess if we're worried about commercial real estate, though, when I think of the sheer size of the CRE market relative to even subprime, we're not even close. We're stratospheres apart in terms of the broader exposure. And this is where I'm not sure people understand. Not you, of course, but the world of everybody who is assessing credit and the potential domino effect from where CRE could go, especially if rates have to go another 100 basis points higher. And in that world, don't the money center banks have exposure to regional banks?
Well, first of all, the money center banks do have their own significant commercial real estate exposure. This is not a concentration for them, so there's less focus on it. But yeah, I mean, I think I have to say, though, I think that their big mega banks benefit from regional banks' distress. Are you suggesting there's going to be some knock-on impact if there's going to be a string of failures with the regional banks? I think it helps them. The business goes there. That's where it goes. They're viewed as too big to fail, rightly or wrongly. I know my former agency, the FDIC, is committed to ending too big to fail and is determined to use the resolution authorities they have if a big bank got into trouble. But the market doesn't believe that. So, no, I think regional bank distress benefits the big money center banks. There's no doubt in my mind.
Sheila, it's Karen. Thanks for being on. A question about Basel III endgame. Two-part question. Do you think it went too far? And how do you think? Where do you think it ultimately shakes out?
Well, I think there's some really good things in it. There's some things that are probably not very good and very, very complex, and a lot of administrative costs from that unnecessary complexity. I don't think that should be a priority right now. Let those rules primarily respond to things that we didn't get done after the great financial crisis. They've been 14 years in the making. My view is they can wait a little longer. Liquidity really needs to be front and center. I know the regulators are working on a new package of strategies and proposals to deal with, to provide more liquidity, mainly by getting banks to use the discount window more and be more prepared to use the discount window. So I expect those to be coming out. But I think that should be a higher priority right now than the Basel III endgame. At some point, those will get done. There's a lot of good things in it, but I don't think that should be the priority right now.